Welcome to the Nadex Application and Strategy webinar series presented by Daryl Martin from apexinvesting.com. Today we're going to talk about Nadex binaries, and specifically we're going to swing trading using the daily binaries. Swing trading is a pretty simple strategy. It's where you're trading between two predefined price levels. And there's a lot of different ways to define the range or the price levels that you swing trade in begin. So basically you're going to trade up to one level and then down to the next and then back up. And you're looking to trade those predefined levels. So you could use things such as fundamentals, such as, what do they say a stock is worth versus where is it trading and it going back and forth. You could use technical analysis, you could use trend lines, you could use support and resistance, or even deviations. Once you determined how you're going to select the range, then it's a pretty simple strategy. You select a range and the price target on that range for where you think the market will get to. And then you locate a binary strike that is near that range of that price target. And you always want to make sure you're looking at, consider your risk and reward. So if I got in here and I got at this price level, what would it be worth? Then confirm the direction and enter the trade. Close the trade, if or when it hits your price target level, and then look to possibly go the opposite direction and open a trade going the other way. And when it comes back down to that price target level, you simply close out the trade. So this is really just an example strategy of how swing trading works, and we're going to apply it to using binary strikes. So in our example, what we're going to do is we're going to go in and we're going to look at the oil futures contract and the deviation levels for the oil futures contract. We go in and I pull up oil, and what I can see is that a one deviation move, which should encompass a majority of the price movement for any given day, will bring us up to $93.56 if the market moves up. Now, if I have a range down, it could bring me down to $89.14. So basically, a one deviation move is between the closing price of yesterday and either up to or down to the deviation level. Well, since I believe the market's going to be moving up because that's how it's been trending, then I'm going to look at the closing price of yesterday as one of my price target levels, and I'm going to look at my higher price target level as $93.56 as the upper deviation level. And I go through all the daily binaries on Nadex, and I find that there is an oil daily binary that says that the oil will be greater than 93 at 2:30 Eastern Time. Let's go ahead and look at the chart on oil itself, and then we'll look at the chart on the binary and see how it responded. Right here we can see the closing price of oil yesterday, and we can see that it moved up. It hit the half deviation, the 0.7 deviation, and then it topped out literally at the one deviation level. So this is where you'd be looking to exit the binary trade that you entered. And then if you wanted to reverse it and do the swing trade, so the way up and then the way back down, then now you could sell that same binary, or you could pick a different one, and you would sell it, and then as the market dropped and went down, then you would go in and you could close out this trade when it came down and it hit this lower level, or the close of yesterday. So the swing being between 93.56 and 91.35 is the swing points that we're looking at for the trade. So in the morning, this is a actual chart of the binary itself, and on Nadex you can open the charts of the binaries. Now you really want to make sure you do have a chart of the underlyings as well, and you can contact us if you need help on that at apexinvesting.com. But right here is the oil binary chart for the Nadex greater than 93 strike at 2:30. So we go in the morning and we look at buying it, and we buy the binary somewhere between $10 and $20. And when we enter the trade, it goes up to our first price target level, and we exit the trade somewhere between $60 and $80. So let's say we got in the trade at $20. That would mean we have a $20 risk. If we have a $20 risk on a binary, and all binaries are worth $100, then our maximum profit potential is $80. Now that's your maximum profit potential if it stays above. If oil itself stays above 93, well, as you can see, if you would have bought this binary, even though you had such a low risk and held on to it until 2:30, then you see how it actually dropped down and would not have really had any value, and you would have given up all your profit potential. So when it hits your price target, you want to get out of the binary. When it hits that $93 price level, again, you want to get out of the binary. So if we bought at 20, and let's say we got out at 70, then that'd have been a $50 profit on a $20 risk. Worst case scenario, if oil stayed flat, we would have lost $20. Or if we never got out, we would have lost $20. But in this case, since we got out when it hit our price target level, then we actually made $50. And that may not sound like a whole lot, but think about it. You risked 20, you made 50. So if you risked 200, you made 500. So you made more than double your money on that trade because it was a profitable trade. And again, if you would not have got out, then your profitable trade would have turned into a losing trade. Well, at the same time, it's at your price target level. So not only could you sell to get out, but you could actually sell another one to go short, saying that you believe that oil will be below the 93 strike at 230. So if you sold an additional one at $70, and a binary is always valued between 0 and 100, since you sold, then it's the price $70 and the difference between the ceiling, which is $100. So 100 minus 70 equals $30. That's your maximum risk on the trade. And then if it does expire below it, the most you could make on the trade would be $70. So you have a $30 risk with a $70 profit potential. Again, that's maximum profit potential. You don't necessarily want to wait and hold it all the way till expiration because it could turn around and swing back up to that same price level. So when it gets back down to your price level of around $91.35, you want to exit out of the trade. So let's say we got out of the trade at $10. If we sold at 70 and we bought at 10, then that means we sold with a $30 risk and we made $60. So if you bought at 10 and then you sold at 70, that'd be a $60 profit. Well, if you sell at 70 and you buy at 10, that's also a $60 profit. So you actually made double your risk on this profitable trade. Worst case scenario, let's say oil would have stayed above 93, then you would have lost $30 on the trade. Or if you would not have got out and oil would have came back, you would have lost $93 on the trade. But since oil did go below 93, then this is an example of where if you got out of the trade at around $10, then you could have made $60 on a $30 risk. So again, let's review the steps on this trade. One, select a range, and you can use, like I said, fundamentals, technicals, seasonals. You could look at support and resistance, trend lines, or deviation levels. Then locate a strike near the range or the target, and consider your risk and your reward on the trade. Once you've considered that and figured out the strike you want, then you confirm the direction. Looks like the market is moving up towards my swing high, and so then I enter the trade. When it gets near at my price target level, I exit the trade. And then if I think the market's about to turn over, it's starting to show that it's going to go back down to my swing low, then I can go in, I can reverse, I can open a trade in the opposite direction. I can sell. If I bought first, then I would sell second, and I could sell and then buy back when it gets close to my price target. And all of these, notice that we are getting out when it hits the price target. We are not waiting until expiration on the trade because we don't want a profitable trade to turn into a losing trade. Now there are weekly, daily, and intraday or 2-hour binaries. And you can choose from all of them which ones you want to trade with. Some of the benefits of trading the daily binaries is they allow you to have a long period of time to trade a selected trading range. They also allow for a large selection of strike prices to choose from because there's a whole price ladder full of different strikes you can choose from to find ones that are ideally close to your price target on the swing trade. And daily binaries will experience a good level of volatility. As you saw, we saw a trade go from 20 up to 70 down to 10. And so there's a lot of volatility in the market. And this was a big moving day on oil, but even on small moving days on oil, you can see a lot of volatility even on a flat day. You can trade towards the upper end of the range, and you can reverse and trade towards the lower end of the range, or vice versa, depending upon which direction you're going. And all of the binaries and the spreads and everything on Nadex allow 100% defined risk. So usually when you're swing trading, one of the scariest things is when it gets up to that swing point and you want to sell, then, what if it keeps going? And where do you put your stop? And you have to figure all that out. Well, with Nadex, all the trades, everything that you do, every one of the products has defined risk, and it can go against you as far as it wants, and you can't lose more than the maximum risk, but you have until expiration of that trade to actually be right. And depending upon which binary you choose, you have the potential for better than a 1-to-1 risk-reward ratio. Unlike on a lot of other binaries out there that are not exchange-based, on Nadex you can go in and, as you saw, we put on a trade for a mere $20, we got out at 70. We put on another trade for $30, we got out at 10. So we had a much better than a 1-to-1 risk reward, meaning risking $1 for the potential to make $1. And we're able to enter and exit before the expiration of the trade. And you saw how these binaries that we were looking at, if we would have bought and held it till expiration, we would have lost on the trade. So it's really important on binaries that wherever you're trading binaries, especially when you're trading on Nadex, is that you do set a price target level and you get out when it hits that level. Now you can also apply this to 2-hour binaries and weekly binaries, and we'll cover this in one of our future videos. To open a live or a demo account, simply go to nadex.com today. Also, visit us at apexinvesting.com to learn more about how to trade on Nadex and to see the tools and resources we have to help you when you're trading on Nadex.